Canada's new federal budget has announced that in 10 weeks' time, the capital gains tax is going to increase by nearly 17%. This is bad news, and I'm going to detail in this video why that is the case, why it's bad for you, Canada, and the other unintended consequences that are going to come as a result. My name is Jonathan Lerner with the Vancouver Life Real Estate Group, and each week I bring you news and updates on the real estate market or tour you through the greater Vancouver area so you can get to know the different areas of the city and know if it's going to be the right place for you to move. Let's dive into today's video and diving into this big announcement on the increase in capital gains. There has always been a tax of 50% for individuals on capital gains. What they announced is that this will remain, and then any capital gains realized above $250,000 will be taxed at a rate of 2/3 or just under 67%. That's an increase of nearly 17%. Now keep in mind that this tax is not just on real estate, it's on capital gains of any kind of investment. On top of this, the increase from 50% to nearly 67% tax will apply to all gains realized for corporations and trusts, and will also apply to professionals who are incorporated, such as your doctors, your lawyers, your chiropractors, etc. So that's across the board. And Bill Morneau, the former Liberal finance minister from 2015 to 2020, has said that the budget is awful and clearly a negative to our long-term goal, which is the growth of the economy and productive growth and investments. I'm going to touch on why that is coming up in this video. On the government side, they are calling this tax fairness for everyone, touting that it's only going to affect something like 0.13% of the population, or in other words, the most wealthy. The problem is it actually affects a lot more people than that, particularly the mom and pop investors or the blue collar workers that are just trying to better their futures. And anyone that has held onto a property for 5+ years, depending on that type of property, could easily be subject to this additional tax, and because it's increased in equity over that time and value. And many boomers were relying on their investments for their retirement without this additional tax, and many Gen Xers as well. And sure, a lot of people don't see gains over $250,000 in a year, but say you sell one property that you've had for a decade or more, and it's your only rental property, and now you're gonna pay a substantial amount more in your tax. And that really hurts our shrinking middle class, and it doesn't just affect the wealthy. I'm thinking out loud on this, and maybe I need an accountant to weigh in on this in the comments below, but what about when a Canadian dies? Will this increase the capital gains tax on their assets when they are passed on? I'm not entirely sure on that, so maybe you can comment down below. All right, coming back to that though, what are the unintended consequences as well around this? So first and foremost, there's gonna be less investment in Canada from bigger corporations, because now their margins will be substantially reduced as a result, because obviously they're bringing in big amounts of money. Less investment in Vancouver and Toronto, especially because of how expensive real estate is, and that's going to prevent the future creation of more jobs and opportunities for our growing population, which then makes it even harder to live here. And you know what, short term, this might move a few more people to sell their investment properties in the next 4 to 6 weeks so that they can complete within the next 10 weeks before the June 25th date. But long term, it's actually probably going to have more people deciding to hold on to their properties instead of selling them. And then they'll refinance and pull equity out tax free. So ultimately, this doesn't improve supply or affordability. And in fact, it probably further hurts the housing market, especially on the new construction side of things, because that's always been primarily investor driven. And now they're going to look otherwise because of this huge more tax. $19 billion of the $53 billion in additional spending in the federal budget is going towards a package of housing and affordability policies, with $8.5 billion of that in housing initiatives, which they have stated a goal of building 3.87 million homes by 2031. That cannot be done. We physically do not have the resources available to even make that a possibility. We've never built more than basically 260,000 homes in Canada in a single year. And if we built at that same pace, we would have just over 1.5 million new homes by the end of 2031. That's a far cry from nearly 4 million. There's no possible way. We don't have the labor force, particularly the skilled labor force necessary to even think about increasing our capacity at that level, let alone supplies and material and all that. So this 3.87 million more homes is basically a guaranteed miss, and something that they're just trying to put out there prior to an election to appeal to the millennials of saying, hey, we're doing things for affordable housing. And here's the other side of the coin that prints a not so pretty picture. The stats don't point to us being in a recession right now, and GDP growth has slowed, and it's not showing that we're in a recession, but it's a mask, because essentially this is fueled by the massive immigration numbers that we've had. You bring in more people into the country, there's naturally going to be more dollars spent in the country. So if you step back and you take a look at the numbers per capita, meaning per 100 people, the GDP has actually been declining for 6 quarters in a row. And most recently, the Bank of Canada has stated that we're in a productivity crisis. There's nothing in the budget with plans to improve that. And so how are we going to produce more in this country and improve our GDP? We're just printing more, creating more debt, taxing us more, and kicking the can down the road for someone else to deal with and look like the bad guy at that point. All right, that's the end of my rant. I look forward to hearing your comments down below. I'm sure I'll get some people in agreement. I'll get some people on the other side. But no matter where you're at, if you have a secondary property, investment property, talk to your accountant, see how this is going to affect you. And if you have investment properties and you're wondering what your next step should be, go right down below this video and book a call with me and my team. And let's have a chat about your situation and seeing what may or may not be the best decision for you with these properties for you. And again, this isn't just on real estate and focus on that. It is capital gains in every single area of investment that you can gain money on. So that is it, everybody. Please comment down below, share your thoughts, and I will see you on the next video.